Good morning, everyone. Today, we're going to talk about a really important aspect of life insurance that often gets overlooked, or perhaps isn't fully understood: the cash surrender value, or CSV, of your policy. Now, right off the bat, it's crucial to know that not all life insurance policies have a CSV. This is a feature exclusively found in permanent life insurance policies here in Canada, like whole life or universal life. If you have a term life insurance policy, it's designed for a specific period of coverage and doesn't build any cash value. So, if you're wondering if your policy has a CSV, the first step is to check if it's a permanent one. So, why is having this cash value accumulate a good thing? Well, there are several significant benefits that turn your life insurance into more than just a death benefit. One of the most powerful advantages is that this cash value grows on a tax-deferred basis within your policy. This means that any investment gains it makes aren't taxed year after year, allowing your money to compound much more efficiently over time compared to, say, a regular investment account that's subject to annual taxation. It's truly a long-term growth vehicle. Beyond the tax benefits, the CSV represents a pool of money that you can actually access while you're alive. This offers incredible financial flexibility and security. Think of it as a personal reserve that you can tap into for various needs, whether it's an unexpected emergency, funding a large purchase, or even supplementing your income later in retirement. It provides a real sense of financial comfort. Another benefit is policy sustainability. Over many years, the accumulating CSV can become substantial enough to actually offset your future premium payments, or even make your policy fully paid up. This means you could reach a point where you no longer need to pay premiums out of pocket, yet your insurance coverage continues for the rest of your life. And, as we'll discuss, this cash value can also be used as collateral for loans. Speaking of loans, a common question is, how much can I actually borrow against my CSV? The amount really depends on the specifics of your policy and who you're borrowing from. If you're taking a policy loan directly from your insurance company, you can typically borrow a significant portion of your accumulated cash value, often somewhere in the range of 80% to 90%. This percentage can vary by insurer, but it generally increases as your cash value grows over time. If you decide to go to a bank or a third-party lender and use your policy as collateral for a loan, they'll also assess the CSV. Banks might lend you anywhere from 50% to 90% of that value, with their terms and interest rates based on their own lending criteria and your creditworthiness, even though the loan is secured by your insurance. A critical point to remember is that any outstanding loan amount, plus any interest that has accrued, will reduce the death benefit paid out to your beneficiaries when you pass away. This leads us to another key decision. Who should you borrow from? Your insurer or a bank? Both approaches have distinct advantages and disadvantages. When you borrow directly from your insurer, it's considered a contractual right, so you usually don't need to go through credit checks or income verification. The process can be quicker, and the repayment terms are often very flexible, without a fixed schedule. However, the interest rate might be a bit higher than what a bank could offer, and if you don't pay the interest, it simply gets added to your loan balance, which can erode your death benefit, or, in extreme cases, cause your policy to lapse if the loan grows too large. On the other hand, borrowing from a bank, using your policy as collateral, might get you a lower interest rate, especially if you have good credit. Your policy also continues to grow unaffected by the bank loan, assuming you're making your payments. But this is a traditional loan, so you will undergo credit checks and be subject to fixed repayment schedules. The policy typically needs to be assigned to the bank as security, meaning they have the first claim on the death benefit to repay the loan if you were to pass away with an outstanding balance. The best choice here really depends on your personal financial situation, your need for funds, your credit standing, and whether you prioritize flexibility or potentially lower interest rates. Finally, a question that often comes up: Do I actually need to repay the CSV I borrowed? For a policy loan taken directly from your insurance company, the answer is often surprising. You are generally not legally obligated to repay the principal amount during your lifetime. This is a fundamental difference from a bank loan. You are, in essence, borrowing from your own accumulating money. However, interest will accrue on that borrowed amount. While there's no fixed schedule for principal repayment, you do need to manage the interest. Otherwise, it will compound onto your loan balance. And, as mentioned, any outstanding policy loan amount, including accrued interest, will be deducted from the death benefit paid to your beneficiaries. If the loan plus interest grows to exceed the policy's cash value, your policy could even lapse, resulting in you losing your coverage. Now, for a collateral loan from a bank, yes, you are absolutely legally obligated to repay that loan according to the terms set by the bank, just like any other loan. Failure to repay could impact your credit and lead to collection efforts. Understanding your life insurance cash surrender value is a vital part of managing your financial well-being in Canada. If you have a permanent policy and are considering accessing its cash value, it's always best to consult with a licensed financial advisor. They can provide personalized advice based on your specific policy and financial goals.